The first budget is always the sales budget. We need to do this one first because we won't know how many units to make or what to purchase if we don't know what we plan on selling. In order to prepare this budget, analysts will look at economic and market conditions, the capacity of the business, because you cannot produce more than you can make, and advertising plans. They will also look at past performance data. Don't worry, you won't have to do any of the analysis in this course. What you need to do is use this information to prepare the budget. Preparing the sales budget is extremely easy to do. You would multiply how many units you plan to sell by the selling price. That's it. Please also note that all the budgets we are doing in this course are very basic. Companies that have many products will have a much more extensive sales budget. Next, we'll discuss the production budget. This budget shows a number of units to be produced in a period. We need to make enough units to cover our sales, and we usually want to make extra so that we have enough units on hand to make sales at the beginning of the next period. For example, if we think we sell 2,000 printers this month, we don't want to make exactly 2,000 printers. This is because at the beginning of next month, we won't have any finished units on hand to sell. If it takes a few days to make a printer, then we will be a few days behind in our sales. The other thing to consider is that since we do always start with some units on hand, then we don't have to make all of them each month. If we needed to make 2,000 units for this month for our sales, last month we would have made some extra for this month. If we made some extra, then we don't have to make all of them for this month. You always want to consider how many sales you're making for this month, plus the extra you want for the following month, minus any you already had on hand, the extra you made from the prior month. This can also be done on a yearly basis or quarterly basis. I'm just using a month as an example. Therefore, we will use our sales information along with our inventory guidelines. The outcome of this budget will be how many units we need to produce for each time period. A simplified formula on how to calculate this is the ending inventory plus sales units minus the beginning inventory. The ending inventory is how many units we want on hand at the end of the time period to begin the next period with. Sales units is the amount of units we plan on selling this month. Beginning inventory is the units we already had on hand at the start of this period. These were the units made extra from the last time period. The next budget we will discuss is the direct materials budget. The direct materials budget shows the budgeted cost for the direct materials that will need to be purchased to satisfy production. We need to do the production budget first. Once we know how many units we're going to produce for each month, then we can figure out the materials we need to buy for each month or each time period. This budget will show us both the quantity, how many materials to buy, and the cost, how much it will cost us for these materials. The formula is the materials required for the production plus the budgeted ending materials minus the materials in the beginning inventory. Very similar to the last budget we did, the materials needed for production would be how many materials we need to purchase for the current time period, let's just say the current month, plus the budgeted ending materials. These would be the materials we want to purchase to have on hand for the following month, minus the materials in the beginning inventory. This is what we already had on hand at the start of this time period. These would be the ending materials from the last time we did this. The next budget is the direct labor budget. The direct labor budget is pretty easy to do. It shows the cost for direct labor that will be needed to satisfy the production. Once again, we need to do the production budget first to know what we're going to spend on our employees making these products. Remember, this is just direct labor, those who are directly working on the product. The manager's salary and other employees who are not working on the product would not be included with this budget. The formula is very simple. How many units we plan on producing times the time per unit. Does it take us 1 hour, 2 hours, 6 hours to make it? The time unit times how much we pay our employees per hour on average. Once again, this is a very simplified structure for this budget. Companies that have many employees and many different products will have a much more extensive looking budget. The factory overhead budget shows the budgeted costs for factory overhead that are needed to complete production. This would be the variable costs that we learned last chapter along with the fixed costs. Once again, this budget becomes more complex with larger companies. On this next slide, I have a few other budgets grouped together. First is the selling expense budget. This is an estimate of the types and amounts of selling expenses expected. We do have a practice problem with this one next. The other budgets are fairly simple and similar to this one, so we won't be doing any practice problems with them, but I do want to go over it. We have the general and administrative budget. This plans the predicted operating expenses that are not already included on the other budgets. This is usually the variable plus the fixed costs for general and administrative items added together. We also have the capital expenditure budget. This shows the dollar amounts estimated to purchase plant assets and amounts to be received from asset disposal. This budget is usually prepared for a much longer time period than the other ones. It could be for a year, but could also be for 5 years, 10 years, or longer. For example, OCC has a capital expenditure budget. It has all the buildings that they plan on either renovating or building new for the next 10 years.